Welcome to another edition of Around the Table with Stacy Smith as we take a look at the economy and investing. Now, since the beginning of the year, the Dow is down about 2%, but the NASDAQ is up 20% and the S&P 500 is up 7%. Despite those numbers and with winter approaching, it just seems as if the bear will not go into his den right now. Instead, it feels as if he could come charging out at any moment and chase the bulls back into the barns. We'll take a look at what is happening in the markets and the economy and how it might affect your investments as we go around the table with Stacy Smith. And here to talk about that is my panel of analysts, and I'm going to introduce them to you now. With the prime seat at the table is Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. Carrie has been recognized by Forbes as one of the top women wealth advisors in the country. Also seated at the table is Frank Brissetti. Frank is the managing director of HF Management Company, which is part of an alternative asset partnership. Now, Frank's background includes 50 years in the investing field, and he helped to establish Harvest Financial here in Pittsburgh, where he was the executive chairman. And there is also one more seat at the table, and that is where we find Michael Godwin with Fregasso Advisors. Michael has a solid career in investing and is the chief investment officer for Fregasso Financial Advisors. And again this year, Fregasso Advisors is listed among Barron's national top 100 independent advisors. One of our regular panelists, Kim Forrest, could not be with us today, but she'll be joining us again when we make our next appearance in a week or two. So, while one bit of news here or there rarely has an impact on the markets or the economy, this could be an interesting week. The Fed wraps up its two-day meeting on Wednesday and will announce what it's going to do about interest rates. Several big corporations are reporting their latest earnings this week, and the jobs report comes out on Friday. So, Carrie, how much attention should we pay to what happens this week?
Well, I guess the question is, when you say we, who exactly do you mean? Do you mean the individual investor, or do you mean financial advisors? Because for us, it's a pretty exciting week. One of the things that is so important, and we really believe this at our firm, is that it's all about the data. It's all about the actual facts of what happens, not necessarily, the speculation and what all the talking heads are saying out there on television, of course, except for this program. So when for individuals, it's very hard for individuals to digest. What does it mean if the Fed raises rates? What does it mean if the Fed pauses? What does it mean if we have a good jobs report? So as an individual investor, I would be very cautious about reacting to any one piece of information. But for us, it's about connecting the dots. So it is an important week. It doesn't mean that there will be a knee-jerk reaction and all of a sudden we're going to change the allocation of our portfolios. But it's going to give us guidance as to how we might want to move within portfolios, maybe rebalance a portfolio, or if someone is adding money to a portfolio, do we want to do it more slowly than just putting the money to work all at once? So it is going to be a very exciting week.
Michael or Frank?
I'll jump in, Stacy, thanks. I think of the three things that you mentioned, was it earnings, the Fed, and jobs? In my opinion, and I'm, thank goodness Kim's not here. I think companies report earnings 4 times a year. To me, that's too much. If they could just space it out to maybe like 2 times a year, that'll never change. That would be a lot better because, 3 months is not a lot to go on when you're looking at longer term. So if you look at what's happened so far in earnings season, companies have done pretty well. They're beating on the top line, meaning revenues, and they're beating on the bottom line, meaning earnings in aggregate, which is pretty good. The Fed, I think, is pretty much baked in that they're not going to hike rates anymore this year. That's what the market is predicting. And even if they hiked one more time, at this point, after how many they've done over the past 18 months, one more hike isn't really going to be the straw that broke the camel's back. We're going to see how that has actually played out. The previous hikes over the next, 8 to 9 months or so, we'll see how those have played out. I do think that the jobs number is the biggest thing I'll be looking at this week. If we start to see those job numbers get worse, meaning more and more jobless claims, that's going to be a signal for us to really start to look to get a little bit more defensive on our equity positioning. Not selling out of the markets, just positioning our portfolios in a way that can withstand any more added pressure that might be seen should the economy start to decline a little bit further.
Can you delve into that a little bit more about you're concerned about the jobless claims?
Yep. Again, the main reason why I think inflation is stayed pretty persistently high is because everybody has a job right now. Unemployment rate's at 3.5%, 3.8%. The economy is still doing very, very well. It's still strong. It's one of the reasons why the Fed has had to keep pressure on those interest rate hikes. So the best cause for inflation is an ensuing recession. Generally, recessions happen when the unemployment rate starts to go up at a pretty good pace here. People start losing their jobs. They stop spending money. The economy slows down now. So that's sort of one of the key impetuses or the key things that we're looking at to see where the economy is heading going forward, and where the economy goes, oftentimes earnings and the stock market can go as well.
You know, Mike talked about quarterly earnings as being too many. And in a way, Mike is correct, because people get a little bogged down in these details. But from my perspective, I look at the corporate earnings and the projections on the earnings based on what Standard & Poor's tells me, and more than quarterly. And when I ran my firm, I looked at my numbers more than monthly. And when I manage my portfolio, I look at the ebbs and flows in the corporations that I own as often as they'll tell me, so I have a feel for what's going on and whether I ought to get nervous or not. As far as interest rates, the general consensus is this week interest rates aren't going to change. The general consensus is that the drop in long-term bonds and the ensuing rise in long-term interest rates has done the Fed's job for them, at least for now. That being said, I see nothing in the way of unemployment announcements of any amount. The United Auto Workers just settled this morning or this week with General Motors, and assuming that the union votes in favor of that settlement, that unemployment issue, if it's an unemployment issue, will go away. So I see employment staying strong for the foreseeable future. And let me say these words. I love the words foreseeable future. And the reason is it means nothing.
You know, it's really interesting listening to our conversation, because, you know, I agree with what Frank's saying about, you know, the job market. I have a little bit of a different view. I know that the market is not expecting rates to go up. And I step back and I say, why? Because the last time the Fed didn't raise rates, and they said there's probably one more rate increase coming, and we've actually had some pretty good economic data out. So I actually won't be surprised if they raise. Now, the markets will perform in a way that we probably wouldn't understand. It will probably go up and then down and then up. But I wouldn't be surprised to see the Fed raise, because Powell has been very direct in saying that, you know, he needs to do what he needs to do, and he may push too far. I think if he does raise, that he actually may be pushing too far, but I wouldn't be surprised. And this relates to the conversation about corporate earnings, because yes, earnings have come out pretty good, but when you listen to what management is saying during these earnings calls, they're very concerned about interest rates and the consumer eventually slowing down. These companies are seeing some cracks from the demand perspective. So very interesting to watch. And that's really where the quantitative and qualitative match up. The numbers matter, the earnings matter, but then what is management doing? What is management saying? Sometimes there's a reason why earnings went down and you really should buy more of a stock. Sometimes it's a surprise and you really should sell a stock. So you have to take a more holistic view.
All right, we do have to take a break. We'll continue this part of our conversation in just a moment.